In this video, we are going to talk about 5 ways to make profit during a downtrend market. So, before starting the video, please like this video. Do subscribe and turn on the notification to our channel for future updates. Investing is not as difficult as the Wall Street gurus make it out to be. If you pay attention to the most popular financial media, you will learn that you cannot make money in the stock market unless you do what Wall Street influencers advise you to do. People, on the other hand, seem to forget that Wall Street financial consultants are the most ruthless crooks in the business. Regular investors are advised to purchase a certain stock or cryptocurrency by Wall Street's huge financial firms, who then dumb it down and leave tiny investors holding the bag. Small investors find it difficult to compete with the largest financial institutions because they have access to significantly more capital than they do. It is possible, though, to outwit them at their own game if you timing the market well, as demonstrated below. The stock market, like the cryptocurrency market, has its ups and downs. Nothing remains in the same position for an indefinite period of time. When the market is in a state of meltdown, there are numerous ways to generate money. Things to do when the market is going down. Many people believe that the current decline in the stock or cryptocurrency markets is a bad thing. The slump in the market, on the other hand, is a goldmine for savvy investors because it is the time of year when you should be purchasing rather than panicking. Because the stock market in the United States has been in an uptrend since the inception of the New York Stock Exchange, intelligent investors continue to purchase stocks in the market. How to plan for the market downtrend. Every month, set aside a specific amount of money for savings. The reason for keeping this money in a brokerage account is that we could utilize it for a variety of purposes if we put it in our bank account. As a result, we don't want to put ourselves in that situation again. 1. Auto-invest. Auto-investing is the most convenient approach to participate in the market because it allows you to cost average down your stocks and cryptocurrency assets. It is simple, so find a brokerage firm that offers auto-investment as an option. This method is ideal if you don't want to devote your time to tracking the market because it is time-consuming to do so regularly. 2. Buy when the market is going down. It might be difficult to watch your stock and cryptocurrency portfolios plummet in value over time. However, for swing and long-term investors, the current market slump may provide a great buying opportunity. The stock market and cryptocurrency markets both offer tremendous potential for profit. Create a strategy that works for you and stick with it. 3. Buy a bearish options. It is possible to make a lot of money by purchasing a bearish stock option if you own equities. For those who are unfamiliar with options trading in general, bearish options are those that are used to wager against a certain asset class or asset class combination. When the market is in a bear market, you win money if the market goes down and lose money if the market goes up, as is the case in a bull market. Trading options is akin to playing a game of chance. Which path you believe the stock price will take is entirely up to you. As a result, it can be the quickest way to make a lot of money, as well as the quickest way to lose everything, because when your options expire out of the money, you lose all you put into them. Can you think of a popular bearish technique that most new internet traders are taught? It is shorting a stock on the open market. Bearish option strategies are used when you anticipate that the underlying stock price will decline in the near future. In order to select the most advantageous trading strategy, you must first determine how low the stock price can fall and how long the downturn will last. If you anticipate a loss in the value of a stock, you will most likely adopt a bearish options trading strategy, which will take advantage of a decline in the price of the underlying asset in question. This has the potential to result in a profit for the strategy. If your forecast proves to be erroneous, you may incur a financial loss. 4. Buying a put option. If you believe the market is headed in the same direction as a short seller, but prefer a trading method with lower and more defined risks, you can acquire a put option. In contrast to the protective put approach, you do not have any ownership interest in the underlying stock. As the buyer of a put option contract, you have the right to sell shares of the underlying stock, often 100 per contract, at a fixed price on or before the expiration of the option contract's term. If the stock's price falls, the put option may become more valuable as the stock's price falls more and further from its current level. This increase in the value of the put option allows you to sell the put option for a higher price than you originally paid, allowing you to profit from the sale. With this method, you could lose money if the put price drops in value, or if the market moves against your forecast and climbs in value instead of decreasing. It is also possible that too much time has passed. However, you are only liable for the cost of the put option that you purchased. 5. Buy a bullish option. Bullish option strategies are simple policies that are implemented by a large number of traders when they anticipate that the price of an asset will rise. In order to find the optimal option strategy, it is necessary to first assess how much the underlying price will rise, and then the duration during which the rally will take place. Purchasing call options in a basic strategy provides an advantage in a rising market, but if a trader fails to cover their position in the event of an unexpected and significant price collapse, it exposes them to a plethora of hazards, including loss of capital. Furthermore, it is not a wise policy to make an acquisition while the market is still relatively bullish in nature. Instead of buying a call, traders could use a bull call spread strategy to increase their chances of success. A bull call spread technique is a type of trading method that various traders employ when the market's price rise is moderate. This method creates a range of prices by using two distinct types of call options, one with a lower strike price and another with a higher strike price, to produce a range of prices. The use of this method inhibits the trader from making a profit, but it also protects and keeps them from suffering a financial loss. Traders can acquire a straightforward call option in order to benefit from rising stock prices in exchange for a small premium. The premium is derived by comparing the strike price of the security with the current market price of the security. The premium will be substantial if the striking price and the current price are both close to each other in terms of value, as they often are. When the price rises, the buyers can exercise their rights to purchase stocks at the strike price if the price remains stable. They can lessen their losses, though, if the stock price remains unchanged or declines, by simply decreasing the premium value of the option they purchased. Having a bull stock option can be a valuable asset to have in a downtrending market, since you can make a substantial profit by timing when the market bottom is reached. If you are an options trader, it is critical that you maintain a watch on the market at all times. Many people make their living through the trading of options. The advantage of option trading is that it provides opportunities regardless of whether the market is rising or falling. 6. Invest little by little over time. People believe that investing whatever they have in their bank accounts at once is the most efficient method to become wealthy. However, the history of the cryptocurrency and stock markets has demonstrated that those who behave in this manner are more likely to lose everything if the market moves in an opposite way than the investor projected. Putting everything into one investment is a horrible idea. When the stock market crashes, you suffer emotional consequences. The moment you begin to feel the dread of losing all of your money, you begin to sell your stocks or Bitcoin coins at a loss. In conclusion, the stock market and the cryptocurrency market are constantly fluctuating in price. In general, there is no formula for the market. If the stock market had a recipe, every investor would be wealthy by now, according to some estimates. Recall that taking advantage of a market slump is the greatest time to invest in your favorite cryptocurrency projects and firms listed on stock exchanges, as you will receive them at a discounted price. Ask yourself how much money you will make if the stock prices of your favorite firms rise again when you see your portfolio in the red. Never allow your emotions or the turbulence of the market to get the better of you. Choose an investment that is right for you, and you will achieve financial independence in a short period of time. Always remember that anything can happen in the cryptocurrency and stock markets, so only invest what you are willing to lose. So, that's it for today's video. What are your thoughts on our video? Please let us know in comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on the notification to our channel before you go. Thank you so much for watching.